I do have a lot of friends, obviously, in the trading world, and some day trade, some swing trade, some position trade, some buy and hold the long term, things like that. There are clear odds on this. It's like it's a given, right? Math is math. If you ignore math, do it at your own risk. And I can't ignore math. Math still is valuable. But so, what are the odds? What are the odds of folks being profitable over long periods of time? Day trading, swing trading, buying and holding. There are odds for these, and obviously each one comes with its own set of risks. Okay. Day trading has become very popular over the last, I don't know, since the pandemic, actually, because people sitting home and swinging options and trading futures and doing this and doing that. Look, I've traded all of it. For me, personally speaking, once in a while, I dabble into zero DTE trading, but that's about it. That's the extent of it. But there are odds for this. So let's look at these odds. Here are the odds. These are facts. You can't argue with these facts. So if you look at the market in a 200-day trading day year, 54% of the time, the market's green on a single day. So basically, if you're day trading, yes, you can go long, you can go short, but let's assume you're only going long. With slippage, with commissions, and with this and with that, that will easily eat away 4 or 5% of your profits. So it's basically a coin flip, 50-50, okay? If you're day trading, those are your odds. You can draw all the lines on your chart, create all the biases, whatever you want. Those are your odds. Those are not good odds for me, okay? Now, if you look at it as a year, green years are 75% of the time. So even with down years, green years outnumber the down years 75 to 25%. If you take it longer term, with a longer term perspective, green decade is 94% of the time. Okay, so we're going from day to 54% to green year to 75%. This is going back 150 years. Green decade, 94%, and green 20 years, meaning after 20 years, if you bought the index, let's say, we're not talking individual stocks, bought the index, S&P 500 or the triple Qs, 20 years, it's 100%. So if you bought an index absolutely at the top, let's assume you bought an index absolutely at the top in 2008 or in the 2008 financial crisis or 2000 dot-com bubble. After 20 years, yes, you're going to say it's a long time, but even if you did not DCA any further, dollar cost average further, you would have been positive. That's the power of compounding. That's the power of dollar cost averaging. That's what I recommend to everybody who's getting into investing. Again, none of it is investing financial advice, but these are the odds. These odds work. These are your odds. Do you want to gamble at 54% after commissions, 50-50, coin flip? Do you want a green year at 75% of the time, green decade 94% of the time, and green 20 years 100% of the time? Long-term investing wins every time. It does. Now, there's other issues with this. There is risks, obviously. Risks are always there, and you have to weigh the risks in. But even with the risk, these numbers hold true. So, but people don't have the patience these days. They want to be jockeys. They want to be hummingbirds. They want to jump from flower to flower. Today's stock is this. Tomorrow's meme stock is that. You do that, you're not going to have that much success, period. I mean, we're just talking indexes now. And what are the risk factors? Well, sure, there are risk factors. Like at the moment, we're overbought, right? 5, 10, 15% correction is normal. Well, if you DCA every time you have a 10, 15, 20% correction, you're going to do wonderful. Because there is also one saying that my mentors beat into me. They used to say, that was before HFT, that was before high frequency trading, obviously, the algorithms and things like that. They used to say time spent in the market will beat timing the market every single time. You buy high, you buy low. That's what I'm doing with Bitcoin, for example. Doesn't matter, right? So greed, extreme greed. Well, it seems like last week before that little 3-4% sell-off, we had extreme greed. All these meme stocks were acting crazy. This is a valid one. High multiples, historically high multiples on tech. They have been there. Every tech stock is, if you look at multiples, is extremely overvalued. But then they become half the market. 7-8 stocks have become close to 50% of the market. Obviously, Nvidia's and pound, all the big names, all the Mag 7s, obviously. Okay, there's a rate cut. Well, now, if the rate cut comes and market's already at an all-time high, is that a positive? Is that a negative? We're going to find out. A lot of people say it's going to be a positive. Well, we're already at an all-time high in all asset classes. Gold at 3,500, real estate, stock market, Bitcoin, pretty close to all-time highs, if not all-time highs. Is the rate cut going to be more positive on top of what we've seen already? I'm not sure. I think I'm not trying to be contrarian. I think the market will read the rate cut as such. Is the rate cut due to the economy slowing? And what's going to happen to those multiples? Because what historically on rate cut reductions, multiples go higher, but we're already at like 26.3, 26.5%. I mean, 26.3, 26.5, not percent, PE ratio for the S&P 500. So we'll see. And, these things, Trump tariffs, that musical chairs continues. We'll still have to settle with the Chinese and Powell firing, but I think he's dead anyway. He's a sitting duck, dead duck. I don't think anybody is going to listen to it. But so those are the risks. But over long periods of time, okay, if you DCA into an index, forget about picking stocks, this and that. Passive investing, as opposed to active investing, has beaten all the short-term stuff that we deal with all the time. Now, how do you manage that? Well, you have to have two accounts. Like I have two accounts. I have a trading account that I actively trade day to day almost, and I have an investing account. You also have to understand the tax ramifications of day trading, right? And not only your accountant is going to go crazy at the end of the year, right? Because you have million transactions and you made 8%. I'm like, what's the point of that? If you're going to actively trade, you need to triple minimum in my book the benchmarks return. Otherwise, don't do it. You're just wasting time. You're just spinning your wheels. Are there some people who are successful at day trading? Sure, they are. But the majority loses because the odds are against you. It's 50-50. It's a coin flip. You can do all you want. Nobody knows what the market's going to do. But over longer periods of time, dollar cost averaging into an index will beat any hedge fund, any hotshot trader, anytime. But we don't have the patience anymore. We like short-term, stuff. We have the adrenaline rush and we get the endorphins flowing if we have a good trade. And then, that's why you have to have two accounts, trade, play your games, whatever you want to do. But make sure you're getting 3x of the index benchmark returns. Beat that by 3x, 4x, 5x, hopefully. And on the long-term side, capital gains tax rates, right? You got to take advantage of that. There's 19% versus your ordinary income tax rates when you're day trading or when you're swing trading short-term. Separating it makes it easier to see a clearer picture. And I do that. I've been doing that for a long time, and I highly recommend you do that. But over long periods of time, investing into an index fund will beat anything else. And that would be my recommendation.